Hello everyone, welcome to lecture 3 of EPS. Today we will be studying the concept of diluted EPS. So give the heading in your notebook, second topic of this chapter, diluted EPS. If you have left space in the summary in the beginning, you can write it over there itself. Otherwise, you give the heading later on in the further pages, diluted EPS. Now, concept of diluted EPS I already explained you in lecture 1 itself. I explained you that there are potential equity shares. I explained you potential equity shares are those securities which have potential of becoming equity shares in future. Then I gave you two examples: convertible preference shares, convertible debentures. In fact, more than 4 examples: share warrants, ESOP, equity stock option plan, employees stock option plan. So what did I explain you in the first lecture was that if these securities, debentures, preference shares, employees get converted into equity shares in future, presently the profit what is distributed between 5, 7, 10 equity shareholders, in future the same profit will get divided between more number of people, because equity shareholders will increase in future when these securities get converted into equity shares. As a result, since the profits will get distributed between more number of people, the earning per share will fall down. And because it will fall down, it is called as diluted EPS. Okay, so this basic concept we already studied in lecture 1. Now all of you write down the formula for that. So write down diluted EPS is equal to adjusted earnings or profits attributable to equity shareholders divided by adjusted or revised weighted average number of equity shares. Now, what difference do you find in the formula compared to the previous formula of basic EPS? In basic EPS, the formula was simply profits attributable to equity shareholders. Here, what is the extra thing you find? Adjusted. Same way, it was divided by weighted average number of equity shares. What is the extra thing you find over here? Adjusted. So what is this adjusted concept? We take it one by one, considering if there are convertible debentures and convertible preference shares. How to find this adjusted amounts? We take them one by one. And then we understand those with practical questions also. So first you give the heading, if there are convertible debentures. So convertible debentures are basically potential equity shares. They have potential of becoming equity shares in future when they get converted into equity shares. Now, if there are convertible debentures, first we understand how will we find adjusted earnings attributable to equity shareholders. Okay, so first we understand how will we find adjusted earnings. Now see, first we start with existing profits after tax. Okay, first we start with existing profits after tax. Assuming there are no preference shares, whatever are the existing profits after tax itself are the earnings attributable to equity shareholders. Now in future, if debentures get converted into equity shares, then we will not have to pay them interest what we are paying right now. I repeat, if debentures get converted into equity shares, we will not have to pay them the interest what we are paying right now. So in future, our profit will increase by the amount of that interest. So we will add interest on debentures. Write them in inner column. Further, we will also add tax on that interest. Further, we will minus from this tax on interest. And net amount will be taken in outer column. Now, understand the logic. Why will we minus tax on interest? See, presently when we are paying interest, our tax burden decreases because interest comes before tax. So our tax burden decreases. In future, if we don't pay interest, our tax burden will increase. Understand it with a rough example first. Okay, understand it with an example. Suppose our profit before interest and tax is 1 lakh. We pay interest of, just an example, 30,000. So our profit before tax is 70,000. Now let us say tax rate is 50%. So 35,000 we pay as tax. And what is profit after tax? 35,000. Now in future, our profit before interest and tax would remain same 1 lakh. But because debentures get converted into equity shares, we don't have to pay any interest. So our profit before tax will also become 1 lakh. Now because your profit before tax becomes 1 lakh, does your tax burden increase or not? 1 lakh 50%, now you will have to pay tax of 50,000. So your profit after tax will become 50,000. Means you can see the profits don't increase by 30,000, they increase by only 15,000. Why? 30,000 you save on interest, but then you also pay more tax of 15,000. Instead of 35, now your tax burden increases. So 30 minus 15, your profits increase only by 15,000. So that's what I did over here. Interest on debentures of 30,000 we add. Tax on that interest, 30,000, 50%, 15,000 we minus. So overall profits would increase only by the net amount of 15,000. So keep this in mind, that in future we will save interest by converting debentures into equity shareholders. So profits will increase by interest on debentures. However, simultaneously our tax burden will also increase because interest is a tax saving expense. So overall profits will increase by what amount? Interest minus tax. And this is what is called as this numerator, adjusted earnings. Okay, adjusted earnings attributable to equity shareholders. So this is how we find our numerator. Okay, considering the effect of potential equity shares, that if debentures get converted into equity shares in future, what would be your profits in future? They are called adjusted earnings attributable to equity shareholders. Now we understand how do we find adjusted WANES, adjusted weighted average number of equity shares. First we take existing number of equity shares. In that we add convertible debentures converted into equity shares. Means we add the number of equity shares which will be resulting in future and given to debenture holders. So if suppose for every 2 debentures 1 equity share is to be given, and if there are 2 lakh debentures, then how many equity shares we would give them in future? 2:1. So 2 lakhs will get 1 lakh equity shares in future. That 1 lakh we have to add. That would become equity shares in future. And what we will get is adjusted weights. And then you apply the formula adjusted earnings divided by adjusted weights. So if debentures get converted into equity shares in future, what would be the future profits and what would be the future number of equity shares? That is shown by adjusted earnings and adjusted weights. Now we see what will be the effect if there are convertible preference shares. So give the heading, if there are convertible preference shares. Now exactly same way, first we'll find the adjusted earnings. So give the heading adjusted earnings. Now what did we do? In the existing profits after tax, we added interest on debentures. Same way here, if there are convertible preference shares in existing profits after tax, we will add, like we added interest on debentures, here we will add preference dividend. But there is one change. When we added interest on debentures, we subtracted its interest tax, means we subtracted the tax on its interest. But here we will not subtract, we will further add the dividend distribution tax. Okay, what is this DDT? Dividend distribution tax, or it is also called CDT, corporate dividend tax. Now understand the logic why we add this. See, we discussed why we subtract the tax, because here interest is a tax saving expense. Means interest comes before PBT. So if you are paying interest, your profits before tax decreases and tax burden also decreases. But does the preference dividend come before PBT? I repeat, I am asking you a question. Does the preference dividend come before PBT? What is the answer? No. Preference dividend comes after profit after tax. From profit after tax, you pay preference dividend, then you pay equity dividends. So preference dividend is paid after paying tax to the government. Does it really save any amount of your tax? No. Moreover, whatever dividend you pay, on that you have to pay dividend distribution tax. Whatever dividend you pay, on that you have to pay dividend distribution tax, which is tax free for the shareholders. Means this burden of DDT is on the company only. Okay, company only gives dividend and company only pays tax on that dividend. Shareholders have that as tax free income. It is exempt in the hands of the shareholders. So basically, dividend also company has to pay and tax on dividend also company has to pay. Now in future, if company does not pay the dividend, then the company also does not have to pay dividend distribution tax. So overall profits available for equity shareholders will automatically increases. In fact, I would like that instead of profits after tax, you mention profits available for equity shareholders. Profits available for equity shareholders. Now that profit available for equity shareholders will increase by preference dividend as well as dividend distribution tax, because if company does not pay preference dividend in future, then company also does not have to pay dividend distribution tax on that. So total profits available for equity shareholders will increase by the sum of both the amounts. So this will be the adjusted profits attributable to equity shareholders. Okay, adjusted profits attributable to equity shareholders. So very important point, keep it in mind that tax on interest is subtracted, but dividend distribution tax is not subtracted, it is added. Now, how would you find the adjusted gains if there are preference shares? First, you take existing number of shares. First, you take existing number of shares. Now, in that you add convertible preference shares. Converted into equity shares. So like we did here, exactly same. Here we added convertible debentures converted into equity shares. Same way here you will add convertible preference shares converted into equity shares. And what we will get is adjusted gains. Okay, and thereafter you'll apply that formula. Adjusted earnings attributable to equity shareholders divided by adjusted weighted average number of equity shares. So when potential equity shares are there, diluted EPS is calculated. And when potential equity shares are there, in future there are chances that the EPS will go down because profits will get distributed between more equity shareholders. So it is called diluted EPS. Now how is that effect calculated if there are convertible debentures in the profits? We will add interest but subtract its tax. Whereas if there are convertible preference shares, we will in the profits we will add preference dividend also and its tax also. And in gains it is same. In the number of shares you add the equity shares resulting from convertible debentures, and here in number of shares you add equity shares resulting from convertible preference shares. Let us take up with the questions including the effect of debentures and preference shares separately. Take out your study material, we take up with the practical questions. Look at question number 7 of your study material. Understand it properly because after that question 8, one more question you all will try entirely on your own. It is a similar one. Miracle Product Limited is finalizing the account for the accounting year ended 31st March 2019 with following details. You are required to calculate EPS means basic EPS. Okay, when they say EPS, it means basic EPS and diluted EPS. So we will count basic EPS also and diluted EPS also. Now, number of equity shares outstanding as on 31/3/19 are 30 lakhs. Means existing number of shares are 30 lakhs. Net profit earned during the year 18 to 19 means current year's profits. Net profit means profit after tax is 96 lakhs. Number of 14% convertible debentures of rupees, make it 100 each, make the correction. Each convertible into 10 equity shares 50,000. So how many debentures would be there? 50,000 divided by 100. Okay, 50,000 divided by 100. 500 debentures would be there. 50,000 is the value, 100 is the face value. So 50,000 divided by 100, 500. Now each is convertible into 10 equity shares, means 500 debentures into 10 equity shares. They will become how many equity shares in future? 5,000 equity shares in future. Okay, they will become 5,000 equity shares in future. These are called potential equity shares. Okay, these are called potential equity shares. Corporate income tax rate is 25%. Let us start solving it. First we find revised earnings, then we find revised gains, then we would find diluted EPS. Anyway, first basic EPS is asked. So write down basic EPS is equal to profits attributable to equity shareholders divided by weighted average number of equity shares. Now, what are the profits attributable to equity shareholders presently? 96 lakhs divided by, what are the weighted average number of equity shares presently? Number of equity shares outstanding as on 31/3/19 are, it should not be rupees, it should be only 30 lakhs. That's it. So 30 lakhs are there. Okay. I think here also there is a correction. Rupees should not be there. Instead of face value 150 also you may keep it, but rupees should not be there. So there are 50,000 debentures which will get converted into 10 equity shares, means it will result into 5 lakh equity shares. Okay, make this correction. Now, number of equity shares are directly given as 30 lakhs. So 96 lakhs divided by 30 lakhs. That is equal to 3.2 rupees. Now we find diluted EPS. So for diluted EPS, first we'll have to find adjusted earnings. So what are existing profits after tax? Okay, we are taking the effect of debentures, what we studied just in the beginning today. Existing net profits or profit after tax are 96 lakhs. Now in that we will add interest on debentures. In that we will add interest on debentures. Now do one thing, keep this face value 150 only. We made that correction considering that 50,000 would be the amount, so 150 face value was not possible. Make it 150 only. Okay, so 50,000 debentures, 150 face value, and 14% interest means what would be the interest on debentures? 50,000 debentures into 150 rupees face value. Okay, 50,000 debentures are there. 150 is the face value, means total value of debentures is 75 lakhs. On that they have to pay 14% interest. So that comes to 10 lakh 50,000 into 14% interest, 10 lakh 50,000. This company will not have to pay in future. So profits after tax will increase by this amount. But simultaneously, tax burden will also increase. So tax on interest we have to minus as we discussed. Means on this 10 lakh 50,000, what is the corporate tax rate given? 25%. On this 10 lakh 50,000, 25% tax company won't be able to save. Company won't be able to save. So 2,62,500 tax burden will increase in future. Means overall the profits will increase by what amount? 10 lakh 50,000 minus 262,500, 7 lakh 87,500 only. So keep this in mind. Interest on debentures we have to add 50,000 debentures into 150 face value into 14% interest, 10 lakh 50,000, and on 10 lakh 50,000, 25% tax we will have to pay more in future, 2,62,500. So overall the profits of company will increase by 7,87,500 plus 96 lakhs existing profit. So 1 crore 3,87,500 will be the adjusted earnings available or attributable to equity shareholders. Means in future, what profits will be available for equity shareholders when debentures get converted into equity shares? 1 crore 3,87,500. Okay, these are adjusted earnings. Now same way we have to find the adjusted gains also. Okay, this is one part we have done. Now adjusted gains. What are existing number of equity shares? Existing, there are 30 lakh equity shares. Okay, in that we will add potential equity shares means debentures which will get converted into equity shares. So here each debenture will get converted into 10 equity shares. So as we discussed, 50,000 debentures into 10 equity shares. 50,000 debentures into 10 equity shares. So in future we will have 5 lakh more equity shares. Means adjusted gains will be 35 lakh equity shares. In future, how many equity shares would be there in the company's books? 35 lakhs. So adjusted gains. Now we apply the formula of diluted EPS. Therefore, diluted EPS is equal to adjusted earnings attributable to equity shareholders divided by adjusted gains. Means adjusted weighted average number of equity shares. Now, what are adjusted earnings in future available? 1 crore 3,87,500 divided by, what are the adjusted gains? Number of equity shares that we will have in future after conversion? 35 lakhs. So what is the EPS that it will fall down to? 1 crore 3,87,500 divided by 35 lakhs. 2.967 means 2.97. See, does the EPS fall down or not? Presently, what is the basic EPS? Presently, the basic EPS is 3.2. But in future, if debentures get converted into equity shares, it will fall down to 2.97. That is the reason, because it will fall down, it is called diluted EPS. So question 8 I discussed with you. All of you try on your own. It is exactly similar one. Be attentive, and then you'll find the solution in front of you. Now see here, question 8. Following details are available of Cipla Limited for the year 18 to 19. Net profit after tax for the current year rupees 1 crore. So there's the existing profits. Number of equity shares outstanding are 50 lakhs presently. So basic EPS will be 1 crore upon 50 lakhs, 2 rupees. Rate of income tax is 20%. Now there are 1 lakh 12% debentures of 100 each convertible into 10 equity shares in future. So again, 1 lakh debentures will get converted into 10 equity shares. Means you'll have 10 lakh equity shares extra in future. These are potential equity shares. 10 lakhs are potential equity shares. Calculate basic EPS and diluted EPS. All of you try the question on your own. Pause the video and try the question on your own, and then you'll find the solution in front of you. All of you try the question on your own. Check your answers, everyone. Basic EPS is equal to profits attributable divided by gains, that is existing 1 crore divided by 50 lakhs, 2 rupees. Existing profits are 1 crore. Now, there are 1 lakh debentures into 100 rupees into 12% interest, 12 lakh interest on debentures. Tax rate is 25%, so 12 lakhs, this 12 lakhs into 25%, 3 lakhs, we will have to pay more interest. 12 minus 3, 9 lakhs, the profit will increase in future. So 1 crore, 9 lakhs would be adjusted earnings. Existing, there are 50 lakh shares. In future, you'll have 1 lakh debentures into convertible in 10 equity shares. So 10 lakh equity shares, so 50 plus 10. In future, there will be 60 lakh equity shares, that is adjusted gains. So adjusted profits, 1 crore 9 lakh divided by adjusted gains, 60 lakhs. Diluted EPS is 1.82. You all can see from 2 rupees, the EPS falls down to 1.82. So it is called diluted EPS. Now we take up with the question on preference shares. This was based on convertible debentures. Now we take up with the question on convertible preference shares. Look at question number 10. Now look at question number 10, everyone, be attentive. Following is the capital structure of a company Beta Limited. Equity share capital 30,000 equity shares are existing number of equity shares of 100 each. Face value is also 100. 9% is the rate of dividend on preference share capital, and there are 60,000 shares of rupees 50 each. Now preference shares are convertible as for every 2 preference shares, 1 equity share of 100 each fully paid up will be issued. So for 2-1 means for 60,000 how many? Half. Against 2-1 means half are issued. So again 60,000, 30,000 preference, 60,000 preference shares will get 30,000 equity shares. So that is potential equity shares. We'll be making the workings for that, don't worry. Profits available for equity shareholders is rupees 19,80,000. Ignore dividend distribution tax. They say ignore. Otherwise, dividend distribution tax, as we discussed in the today's lecture itself, it would get added. Okay, as we discussed that if dividend distribution tax was there, then that also we have to add and not subtract, unlike debentures. So first we will find basic and diluted EPS. So first let us find basic EPS right now. Basic EPS is equal to profits attributable to equity shareholders divided by weighted average number of equity shares. Now existing profits attributable to equity shareholders are 19,80,000 divided by weighted average number of equity shares. Means here are presently we have 30,000 equity shares. So 19,80,000 divided by 30,000, that is 66 rupees. Rupees should be mentioned without fail. Now for diluted EPS, first we will find revised or adjusted earnings. So what is the existing profits? Now we are taking the effects of preference shares. Okay. So what is the existing profits attributable to equity shareholders? Now, existing profits attributable to equity shareholders are 19,80,000. In that, we would add preference dividend as well as dividend distribution tax. But here it is given ignore dividend distribution tax. So we will add only preference dividend. What is preference dividend? See, 9% of 60,000 shares into 50 rupees each. Okay, 60,000 preference shares into 50 rupees face value into 9% dividend. Since dividend distribution tax is not given, so we will directly take this in outer column. 60,000 into 50 into 9%, that is 2,70,000. So in future, when preference get converted into equity, we don't have to give them dividend of 2,70,000. So profits available for equity shareholders will be 19,80,000 plus 270, 22,50,000. What are these? These are the adjusted earnings attributable to equity shareholders. Now we find adjusted weights. What are the existing number of equity shares existing number of equity shares are 30,000. In that we add potential equity shares means the preference shares which will get converted into equity shares. For that, we'll make a working over here. It is given for every 2 preference share, 1 equity share will be given. So write that. For 2 preference share, 1 equity share will be given. Now there are 60,000 preference shares. So how many equity shares will be given? 60,000 into 1 by 2. That comes to 30,000 equity shares will be given. So existing 30 plus 30 total, there will be 60,000 shares in future. That is adjusted weights. Now we apply the formula of diluted EPS. Therefore, diluted EPS is equal to adjusted earnings attributable to equity shareholders divided by adjusted weights, that is weighted average number of equity shares. Now, what are adjusted earnings attributable to equity shareholders? 22,50,000 divided by what are adjusted weights? 60,000. So 22,50,000 divided by 60,000, 37.5. Now you all can see that earlier the EPS was 66. Now the EPS is 37.5. Has it gone down or not? This is what is called diluted EPS. So in this lecture today, we have taken with one by one separately the question where we have convertible debentures and convertible preference shares. In the next lecture, we'll take up a combined question. That means in a single question where we have convertible debentures also and convertible preference shares also. And mind well, attend the lecture because it's not simple as you understand. What's the complication? Wait and watch. See you in the next lecture. Bye everyone. Take care.